why don't you, as we get into this week's housing market update, just give us a high level 30,000 foot view of what in the world's going on with this market, with interest rates. What are you seeing from the Fed's perspective that's driving their decisions right now?
Yeah, the market is 100% driven by tariffs. So I hear it everywhere. Like every car advertisement is tariff. Furniture stores are tariffs. I bought like these plastic chairs that go in my pool, and they're like, we don't have tariff price increases, So everybody's really running on that buzzword. And it's what's controlling the market. If we look at for interest rates and the Fed and all these things, like all the data, right? So as we've always talked about, inflation and the jobs market, these two things, there's too few jobs for too many people. They can get as many jobs as they want. That means that they can make as much money as they want. And if there's too few goods for too many dollars, we have inflation, right? And so now the thing is like, okay, we've got inflation coming down. We look at all the government controls. We look at PCE and CPI and the government, these boring indexes that we talk about, that the government manages inflation on, and they're all coming down. Personal income is going up. These prices are coming down. Like things are going really well, but everything that should drive the market, that should drive the rates lower, like everything's great, but we don't know what tariffs are going to do. And that mainly comes from the amount of tariffs that we think that we're going to see by the time it's all said and done. And if you come from, depending on your school of economics, like, do you think inflation is too many dollars chasing too few goods? Or do you think inflation is the prices of things going up, right? Which you think would be the same. However, if you have a balanced job market and every Tom and Larry in town can't go out and get more money because a washer and dryer costs $500 more, well, now they have $500 less to spend on other goods. So is that tariff really inflationary if you're taking $500 from another market or another product? So as far as what the Fed's doing, the Fed's like, look, everything looks good. Like we're happy with the way inflation is moving. The job market is much more in balance. There's way fewer job openings, which means that the labor market's tighter, which we want. But we don't know the full impact of these tariffs. And so that's really what's driving rates. So
is it because of just maybe fear of we're not going to make any decisions that will drastically lower these rates, which would unlock the housing market, so to speak. We're not going to do that until we see the ultimate impact of these tariffs.
Exactly.
Yeah.
100%. So waiting on that, right? And then we also have the other big one is the big beautiful bill, right? And so there's this big bill moving through Congress, and part of that, there's tax deductions, like this tax laws that were put in place in 2017 would remain. And I think that makes those permanent, which would be very good. It lowers a lot of corporate income tax, which reduces the government's take on GDP, which is a really good thing. But the other part of it is it deregulates some of these banking regulations, which have to do with how much banks can have invested in treasuries and things like that, where these bond markets that are tied to rates, a lot of these banks are limited to how much they can have of those based on their risk. But really a United States government treasury is considered a risk-free investment, the same way pretty much like a mortgage-backed security is today. And so by deregulating some of these banks, you start to lower that spread between treasury bills and 30-year mortgage rates. So there's a lot of different things in the works that are just taking time that should unlock the housing market. And that's why you're seeing these reports with Fannie Mae and Freddie Mac coming out and saying, we're going to revise our rate forecast for being lower at the end of the year.
That's right.
Because they believe that these tariffs aren't going to be as big of an impact as we think they are on inflation. And we do think that some of these deregulatory things are going to open up more investment vehicles for banks and other institutions in this bond market.
Yeah, no, that's super well said. And that's exactly right. I mean, I made a video last week talking about, the new update, I think, suggests that by the end of 2025, interest rates are, 6.1, 6.2, and then getting into 2026, that they have a 5 in front of them. And so I think with that forecast, with that assumption, yes, this unlocks this industry, which is been difficult. Transactions are way, way down. There's 500,000 more homes on the market now than there were last year. Inventory's up, yet people are still purchasing homes. I think that buyers that were really, really, maybe call it 18 months ago, waiting on the sideline, not doing anything, will said, well, we have to buy. We still have to do something, in that the buyers have accepted the fact that it is what it is. Normal. That's the new normal.
Accepted the new normal.
Yeah. And so tell me your perspective of how you see this new normal playing out in the market right now.
So, I get the objection a lot, right? When I'm talking to buyers and I'm like, hey, I've had you pre-approved since 2024. This it's been a little over a year. Like, what's holding you back? It's rates. Like, okay, what are you so are you waiting for rates to drop? Yes, I'm waiting for rates to drop. When do you think that will happen? I'm just asking them, knowing that I know that there's really no answer to that, but seeing what their perspective is, and they have all these different things, maybe 1 year, 2 year, 3 years. And so I always come back to do an ARM, do a 7-year ARM. I can do a 7-year ARM today at 6.125% with no points.
Wow.
So you have a rate that's fixed for 7 years. And on month number 85, that payment is guaranteed to do one of three things. It's guaranteed to stay the same, go down, or go up. One of those three things is going to happen, where if you stay in a 30-year fixed, your payment's going to stay the same, and you don't have the opportunity for it to go down, which, if you think about it, if rates are at all-time highs, right? Would you agree with that?
Yep.
And all these indexes are at all-time highs, right? Yep. Not all-time, maybe 25 years.
Sure.
And so if you look at a lot of these indexes that adjustable rate loans are tied to, if you have an adjustable rate mortgage, and this is getting super technical and I'll try to avoid it, but an adjustable rate mortgage is tied to, let's just say the big one now is called a 1-year CMT. And that's like a constant maturity treasury. It doesn't matter. It's called 1-year CMT. And the reason they choose that index or that rate to tie these loans to is because it's not a psychopath. Like, it's kind of slow and steady, and it stays fairly calm despite ups and downs in the markets. Well, that rate today is 4.12%. On a 7-year ARM, in most cases, for good credit conventional ARMs, you're going to be 2% above that. So even if your worst case scenario, if you had this ARM 7 years ago and it adjusted today at an all-time high or a 20-year high, it's adjusting to 6.12%.
Yeah.
I can get you a 6.12% now. And in 7 years, you can deal with the adjustment then, and you're going to be building equity and saving on, I don't know, $400,000 loan today. You're saving $250 a month, and you end up further ahead in the principal. Or you can take that 30-year fixed and ride it higher, knowing that you're paying more, thinking that you're going to refinance anyway. You can refinance a 7-year ARM the same way.
That's what I was just going to say. I mean, the 7-year ARM, the argument is that you are likely going to refinance with inside of that time period anyways. And by the way, the other assumption is that between now and 7 years from now, that interest rates, to your point, will be lower than they are right now. So for perspective, if someone's looking to purchase a home and they're looking at a 30-year fixed rate mortgage versus a 7-year ARM, what is the difference in rate, just so that the audience can have perspective?
0.75%.
Okay, so 6.75 versus, or even more so than that.
Yeah, so a 30-year today realistically is just below 7%. So you're like 6.9.
Okay.
A 7-year ARM, you're like 6.125 to 6.25 today.
It's a big deal.
It's a huge deal.
I mean, and why? And then consumers, and no one's talking about this. This is why I love that you're talking about this, because there are options like this for the consumers that think, okay, well, I'm going to wait until interest rates come down, to your point, because I don't want to get a mortgage at 7%, which is not, they don't have to do that. There are other options.
100%. And so that's why I was asking them, like, what do you think is going to, so are you just never going to move?
Right.
Well, no, I know rates are going to come down. If rates are going to come down, do an ARM and refinance it. You can refinance an ARM whenever you want. It's exactly the same thing as a 30-year fix until month number 85. And then you've got an option where your payment goes up, down, or stays the same.
Yeah.
So that's my solution for that objection or for that pause. And I can tell you that I started doing that maybe like 3 or 4 months ago, really getting in, now realizing like, okay, rates aren't going to drop. They're not falling off the cliff. This isn't going to move that market. And we started doing more of these ARMs, and ARMs actually, those rates move a little bit more than a 30-year. So I did one like a 40% down purchase. They closed 2 weeks ago at 5.25% on a 7-year ARM.
Wow.
So that was like a really, really great credit, larger loan amount, big down payment. But that loan was really, really low. And the borrower's like, how come more people don't tell me about these. Like I never even knew how an arm worked. I thought they were bad.
Well, and that's exactly the point. That's why we're making this type of content is that there are options for people.
Yeah.
Let me ask you, so because inventory is higher, because the days on market has increased, how many purchase transactions are you in where it's still a competitive bidding war, multiple offer situation? If you had to guess, like percentage wise, how often are you finding your clients or your buyers in those situations right now?
50%.
You're still seeing it half the time because the homes, although inventory's up, you would say that the homes that are the most desirable still have great demand regardless of rates.
Absolutely. And the neighborhood, right? Like depending on where you're buying. Like so for our area, there's certain pockets of areas where you can't get in there unless you're bidding $100,000 over the asking price up till today.
Sure.
And we closed loans just down the street from where you live that were bid $110,000 over asking. And then there's other ones where I have buyers out there getting 6% seller concessions on FHA loans, and they're taking a property that sat there for, now it's like this house been on the market for 2 weeks, dude. Like I am going to punch them in the face with this offer and we are going to get this deal. That's the perspective because of what the market's been. So like a 2 week old home, or God forbid you've been on the market for 60 days. They're like, I'm coming at these people angry, and so it really is, it depends on the home, but we do see a lot of competitive getting outbid situations. Yeah, for sure.
So I guess let me ask you this, as we hopefully start to see these interest rates come back down, the big thing when the whole NAR settlement thing happened was buyer agent commissions and how that's going to affect things and who's going to pay for what and how it's all going to be negotiated. Now that dust has settled, what we see is the thing that I've been talking about for a long time, which is that if buyer agent compensation is not being offered inside the MLS, which is not anymore, that it'll be a big nothing burger. That it will be business as usual. Yeah. What has been your experience on the lending side of things as it relates to buyer agent commission?
Nothing burger. It's literally. There's a few cases where I've had clients, that paid the seller would only pay the 2% of the buyer's agent commission, and you get some buyer's agents that are like, okay, that's great. And then you have some that are like, well, we signed that agreement at 3%. Like, you got to pay me. Yeah. And they will. And maybe they try to work it into some concessions through the inspection or something like that. Or they've just paid them. Like, I've had to put it on closing disclosures where they're paying a certain percentage of that buyer's agent commission. So, but really it hasn't been a deal breaker in any way. I think I've talked to, it just happened like last week that somebody was like, yeah, I'm kind of interested. I'm going back and forth, but I don't want to commit to an agent or really look at a house with an agent because I don't want to have to sign a piece of paper to go open a door. Yeah. So they're like the open house circuit is really working for that buyer.
That's exactly right. And that's a whole nother episode, but that's why I think that, listing agents are in a really good position, especially with open houses. Are you seeing a lot of your buyers go directly to the listing agent out of curiosity?
Some, yeah. You get some that do, and there's a lot of just traditionalists too. Yeah. It depends. It really depends on the agent, so you have some agents that are like very established agents that I work with. And these guys, like their clients are ride or die. Like, I am this person's person. Sure. And then there's some newer agents like, yeah, this guy sign called me on another one of my listings and we couldn't make it work. But now, I'm going to this property, which I think has always happened, but I'm getting a little bit more of that like sign call for their house, which is a good agent, right? If you're converting a sign call into a buyer agent in the next conversation. So
just to recap though, on the buyer agent commission, I just want to make sure I understand that right. You're seeing that what you explained was the anomaly, not the norm, and that 90% of the time you're seeing that sellers are still paying buyer agent compensation. Buyers are not having to pay it. It's just part of the offer.
Yeah. Every day. Yeah, exactly.
Yeah. And so
it's what we all said, right? We're like, it's just going to be another page.
That's it.
That everybody signs.
Yeah. Yeah. So yeah, that's exactly right. So as you look forward, right? So we're making this video in the beginning of June. What are some of the things that we need to look out for in the next few weeks that may impact some of this unlocking of the housing market and mortgage rates?
So, every first Friday of the month is always a huge one. So that's going to be our unemployment report. Again, that's driving more money, chasing fewer goods. So we'll look for that. And then this whole week is really all employment data. But again, the problem is whether we miss the employment number by not having enough jobs or we way overblow the employment number. The market's like, the response is very muted in the bond market just because, well, we don't know what's going to happen with tariffs.
Yeah.
So that's really the thing. And, if it's, I don't know how else you get the news on what's really happening with tariffs other than listening to the radio and watching the Bloombergs and the CNBC and the Fox. You're trying to get like a good mix of everybody. And they all say the same thing, like we're close on a few deals. But I know that watching that big, beautiful bill, like I know that they're really pushing to get that through before July 8th, which will be a big one. That'll have a lot of that bank deregulation. I think that'll be something that we can really watch for the markets. I would also watch what's going on with Fannie Mae and Freddie Mac and removing them from the conservatorship that they were in, or whatever it was. I think it was called something similar to that, where they're still being backed by the government, but a little bit more private. That's going to give them some more flexibility. And then also what they're doing with the CFPB. So the CFPB is the Dodd-Frank, or the big regulatory act that was put in place basically after 2008 for consumer financial protection. And while that makes a lot of sense for the consumer, and they're still going to be protecting the consumer in a big way, they're basically taking that from like a profit center to something that's actually regulating the bad guys, which would be a really good thing for banks and mortgage people and all that. It just gives more flexibility and also decreases some of that spread between the 10-year treasury. So those are the things that I'm really watching. I follow Bill Pulte on Twitter and pay a lot of attention to that. That guy very much comes from a single family home, this big, huge Pulte Homes, and very much has his finger on the consumer real estate market more so than the commercial market and things like that. That guy really empathizes with our world. And I think that'll be a really good thing too.